Hey everybody, it's RC Peck here. Great to have you here for my training called Peak Gold. My voice is a little tired. I was with the kids playing all day yesterday and we were just having a great time. So if it sounds like my voice is a little hoarse, that is why. It is so good to have you here. I want to make sure that you guys can see my screen and hear my voice. So over in the GoToWebinar control panel, there's a section called questions. If you just go over there now and say, yeah, RC, I can see, or I can hear your voice and I can see your screen. My screen, in case you want to know what it looks like, it says at the very top, today you will discover why ... And then in the middle it says Peak Gold. Okay, great. Yep. Okay, I see them coming in. Thank you. Thank you. You can hear me, can see me. Thank you for letting me know. A lot of people from different parts of the country. And we have some European people calling in too, so that's great. It's so good to have you all here. Let's get started. Let's jump in. Before I do, actually, I probably should have said this. You're probably going to want a pen and paper, or if you take notes via computer, because I want to make sure you get a couple of the key principles that I run my investments by on this call. And look, I don't know what you're going to like best about this training, how kind of it encompasses everything that is most important, yet maybe is not as popular, or how it really reframes the way of investing, not just in gold, but actually investing in general and specific, because it is a very different way to invest. And over the last 2 decades of me working with people and individuals and their money, I've noticed that what we often believe to be true is not. So with that, let's start. Now, at any point, if you feel like I don't know where RC's going or I lost track of him, I want to show you 3 charts quickly. And this is what the entire conversation is about. So this is the best 12 years gold has ever had. And this is the most recent, 2000 to 2000 at the end of 2011. And during that time period, gold went up 423%, which is the red line on the screen. And then the blue line on the screen is what I call ltech gold. It's not necessarily gold. It's the strategy called ltech gold. ltech, LTEC stands for long-term economic cycles. And that went up during the exact same time period, about twice of the move of gold. So that's in the good years what ltech gold can do. And then in the bad years when gold had its worst 3 years ever, 2013, 2014, and 2015, gold fell 23%, and ltech gold was up just a little under 2%. So if you get lost or your brain kind of floats away and then comes back, you can just remember these 2 price charts and go, this is why I'm on this call. This is what I'm learning to do to get my life, to get my money, to get my portfolio, to get my future on the blue line. And then lastly, this strategy also points out some of the best stocks you can own. This is ltech Gold's best gold stock ever. And again, you're starting to see that this is probably a different way to invest, if not already. And that is an individual stock, and it's the blue line and being compared to the red line, which is the Gold Bugs Index XAU. And you can see that it has done something very different, especially in the 3 worst years gold has ever had. So if you lose track, you can just load up one of those and say, okay, this conversation, this training is about getting my life, getting my future, getting my security on that blue line. Now, before we get into the entire training, I want to give you my agenda, then I want to give a disclaimer. So the agenda, I want to talk about where we are today as a country, as an economy, as gold. I want to talk about why gold and not something else. I want to talk to you about why gold stocks don't actually matter as much as this one thing, which I'm going to tell you what it is specifically. And this is a very big point that most people miss. And I want to talk to you about how to get access to my research. And then I'm going to take questions live, and I will answer them. Now, before I jump in, I just want to point out, look, I'm going to say things in here, even though this is a training, even though you did not necessarily pay for this, I'll probably say things in here that maybe turn some of you off, and it for sure will turn people off outside of this conversation. My intention is not to have you get mad at me. It's just to simply point out to you right now, we often believe as humans things that actually aren't best for our money. We do things that we think are going to be best for our money, but they're actually not. And that's what really hurts our portfolio and our investments. It's our beliefs. And so I will probably say things in here that go counter to what people believe to be true. Okay, the SEC disclaimer. I am a certified financial planner and a registered investment advisor, and I have to have a disclaimer by law. So I want to read it to you. The opinions expressed in this training is for general information purposes only and not intended to provide specific advice or recommendations for any individual on any specific security. It's only intended to provide education about the financial industry to determine which investments may be appropriate for you. Consult your financial advisor prior to investing. Any past performance discussed during this program is not guaranteed of future results. Any indices referenced for comparison are unmanaged and cannot be invested in directly. And then lastly, as always, please remember investing involves risk and possible loss of principal and capital. Please seek direct advice from a licensed professional. Okay. Now, I got to point out the obvious, and it's hard to point out the obvious because it's around and it's all over the place, so you don't necessarily see it. There is an incredible amount of information out there on investing. You get hit on the cable channels, you get hit with blogs, you get hit with Twitter, Facebook, in your mail, newsletter companies like Agora or Porter Stansberry. They flood your inboxes with promotions. We get hit with so much information. Mark Faber, great economist, has his own company. He's on a lot, often saying that things aren't going to do well. He's kind of known as his company, his newsletter is called Gloom, Boom, and Doom. Boom is in there, but doom is in there too, and so is gloom. So we get a lot of negative news out there, and we get a lot of negative information. And look, quite honestly, negative sells really well because the human body is formed and designed, the brain is designed to pay attention more to negative information than positive. And that's the way the brain has designed. And then, you got Eric Sprott coming out. You got these really well-respected people. You got Barry Ritholtz coming out. You got David Rosenberg. People coming online talking for 1 minute, 2 minutes, 5 minutes in sound bites. And you know what? It's just hitting your limbic system really badly. Your limbic system is your emotional part of your brain. And it just takes over. And it floods your brain with cortisol. And this is things that actually happen. Yes, we're going to talk about investing, but I need you to get what the biggest part of investing is how you behave as a human around investing. And look, I'm guilty, or at least I used to be guilty of it. I was on kind of the circuit for a while too, on Bloomberg, on CNBC, on NBC, on Fox Business News, both, and not Fox Business News in Asia, but also domestically and in Asia too. And I was on, and I saw the kind of the flip side of it, of how everything needed to be sound bites, and you needed to have one position or the other position. And they loved it when people disagreed because it made for good TV. Just think kind of Jerry Springer-ish. So they loved it when two people disagreed passionately. And fortunately, I'm actually pretty good at disagreeing with people. And so they loved having me on, but I actually gave it up, even though it actually grew revenue. It increased revenue in my company because people would see me on TV and then they'd see the name Fearless Wealth, which is very memorable, and they say, oh, Fearless Wealth, I can remember Fearless Wealth. And they'd go to my website and they contact me literally and say, I saw you on CNBC or Bloomberg talk about utilities or Home Depot or gold, and I want to talk to you. But I just felt like I was part of the problem. I was part of the industrial investment complex, just creating more noise. And so I stopped. But he did not stop helping people find out what really works. So look, I'm a certified financial planner. I mentioned that. I'm a registered investment advisor. I'm part of the Financial Planning Association. Why this matters is because I have a different point of view. What I mean by that is I'm a fiduciary to my clients. I have to put their money first. I am not this person just writing newsletters with opinions and editorializing ideas. For a living, people come to me and ask for help, especially after they've been hurt by other kind of big box and independent advisors. I'm married. That's my wife and I on our wedding day. And we have two gorgeous little people in our lives. The little one is my daughter, and the slightly bigger little one is my son. Now, that's an older picture. That's about 4 years old, but I just love the picture of those two sweet loves. So that's a little bit about me if you don't know. Okay, where are we today? We are in a world of uncertainty. Whether we were we're not in a world of uncertainty, you have to understand that your strategy defines your choices, your security, your future, and not what assets you own. Now, the industrial investment complex, newsletter companies, big box advisors, workshops, they've all told you it's all about your assets. And that is wrong, right? People often believe that if they just have the right assets, then their future will be taken care of. But actually, that's not true. And if you just notice, it's not the assets, it's actually the strategies that determine what assets to buy and not buy. Then you start to get that it's actually the strategies that define your future, your choices, your portfolio size. So, what is going on? Let me read this to you from the New York Times. 2 years ago, gold bugs ran wild as the price of gold rose nearly 6 times. But since cresting 2 years ago, it has steadily declined, almost by half, putting the gold bugs in flight. The most recent advisory from a leading Wall Street firm suggests that the price will continue to drift downward and may ultimately settle 40% below current levels. The rout says a lot about consumer confidence in the worldwide recovery. The sharply reduced rates of inflation combined with resurgence of other more economically productive investments such as stocks, real estate, and bank savings have combined to eliminate gold's allure. Although the American economy has reduced its rapid rate of recovery, it's still on a firm expansionary course. The fear that dominates 2 years ago has largely vanished, replaced by a recovery that has turned gold speculators' dream into a nightmare. The question is, when was this written? Was it last week? Was it this morning? Was it a month ago? I mean, think about that in your brain. Like, just go ahead and just answer out loud. Today, RC, last week, last month. Well, this was August 29th, 1976. And the reason I bring this up is because we are bombarded with information. Yes, I'm still talking about that. And I'm talking about where we are today. It feels very uncertain because of all the information out there. Now, 3 days after this was published, gold started a 3-year, 800% rally. You have to find a way to eliminate the noise. Otherwise, it doesn't matter what you own. This is a key part that no one talks about. Now, newsletters may say this, right? Pick of the month newsletters, but they create the noise and they rail against the big box advisors in the industrial complex. But what they don't understand is they're actually the industrial investment complex themselves. So, where are we today? This is the Japanese 10-year yield on their government bond. It is negative. If you give money to the Japanese government, they're going to give you back less money each year. There are negative interest rate policies going on in Japan right now. Every year you get about 15 basis points less of your money back each year. You give your money to the government of Japan, they're not going to give you a dividend yield. They're going to take a little bit of it. That is called repression. That is how people get poorer each year without kind of visually recognizing it. And this is where we are today. We are in uncertain times. Governments make interest rates negative, right? Or they make them zero when they are very uncertain about what's going on. And the reason why Donnie and Bernie, or Bernie Sanders and Donald Trump, are trending so well right now. And this is, I'm not saying whether they make it or they don't make it, but how can those two people have such a meteoric rise that they have? It's because people are concerned, as concerned today as they were in the 70s and the 30s. And this is what you're looking at today. You're looking at uncertainty on this price chart. And we go over to Germany, and you see the same uncertainty. You see the European economy very uncertain. Now, you give your money to the German government, they're going to do a little bit better than the Japanese government. They're going to give you back 15 basis points a year. So 1% is 100 basis points. They're going to give you 15 basis points. So look, it's better than Japan, which is going to take 15 basis points. But you're looking at uncertainty here. You're looking at concern for the future. You're looking at central banks that are impotent, not important, but are impotent. They've lowered rates, didn't help. They printed trillions of dollars, it didn't help. They've lost control. And maybe they never had control, but you're looking at very uncertain times here. And this comes after the 2008 stock market fall of 58%. We are in uncertain times. Now you look at 5-year government bond interest rates across the world. You got Switzerland taking about 75 basis points from you. The Netherlands, not quite as bad, taking about 25 basis points. Germany taking about 25 basis points. Austria taking about 20. France is going to take some. I mean, this is pretty amazing. You've got major developed economies: Denmark, Sweden, Japan, Finland, France, Austria, Germany, Netherlands, Switzerland. These are major, major developed economies on the planet. 30% of the developed world is living under negative interest rate policies. We live in uncertain times, even with the United States at a positive interest rate for its 5-year treasury. It's just barely over 1%. Now, I don't know where you live, but I live in Silicon Valley, have for 18 years, and inflation in Silicon Valley is 5%. So if I give my $100,000, let's say, to the U.S. government, I'm going to lose 4% a year. 4% a year, let's say it's $500,000. That's $20,000 a year I'm losing. Even if it's just $100,000, I'm losing $4,000 a year in purchasing power. This is what's going on today. This is uncertainty. This is the loss of control that central banks have. And there's a long history that gold has settled things. It settled things in the 30s, it settled things in the 70s, and it's going to settle things again. That's where we are today. We're in a world of uncertainty, and everywhere around us, other than maybe the top 1%ers, and even some of them when I talk to them, they're still concerned. Now, when you have negative interest rates, or when you have low interest rates, or when you have a zero interest rate policy, you have something when your real interest rates go negative. And now a real interest rate, all that means is adjusted for inflation, right? So if the U.S. government is giving you 3% on your money and inflation is 4%, that means you're losing 1% a year. And that means in that case, real interest rates would be negative. Well, in the two gray sections, you can see that gold does exceptionally well when interest rates get negative, when that real rate of interest is negative. And we're in that now. Now you can see this started in 2000, and we had a really big correction in 2012, 2013, 2014, and 2015. And I'm going to talk about that too, because it's not enough just to know about a real rate of interest and whether it's negative or positive. You need another step, which I'll talk about. But you can see how gold has really moved. And what I believe has been this correction, which the ltech gold strategy, which we'll talk about, kept you out of the majority of it. And we'll get to that. The point is, where are we today? We're in a world of uncertainty. This comes after a decade of uncertainty. This comes after a lot of people having what I call financial PTSD. And I'm not making light of actual wartime PTSD, post-traumatic stress disorder. People have a lot of trauma over what's happened to their finances. They're having anxiety attacks over what happened to their finances. 2008, a 50% loss. 2011, a 20% correction, almost overnight. The last 2 years, the market's been going sideways in a very erratic 15% channel. This is real financial PTSD, and people are concerned. And unfortunately, they're turning to the industrial investment complex, and that's the exact complex that wants you to turn to them. So here's the deal. Now, I know you don't know who Michael Tarnoff is, but look, he went looking for what really works. And, one thing he said was, what RC teaches is not taught anywhere at any price. Now, the thing that he got from getting my research and kind of learning this way is he goes, he said, it's like, I don't want to have to look anymore, RC. I used to think it was a hobby, but then I realized I didn't actually want this to be a hobby. And he was looking every day, every week, every month, every quarter, and now he doesn't have to anymore because he has a strategy that does that for him. He was able to cut down how much he works, literally having a 4-day weekend. And he's missed every major market crash in the market over the last 10 years. I'm not saying you're going to get this. I'm simply telling you what happened to him. Notice I didn't say that he doubled his money in 2 days and made 18,000%. You know that stuff is garbage when you read it. I'm not saying it didn't happen, but the likelihood of you bought that one option at that one day at that one price is so low. Well, you know how low it is. What I'm saying is this isn't about those ridiculous claims. This is about what really works. So now, why gold? Why should you be in gold when times are uncertain? Why not something else? Why not coffee, sugar, cocoa, some commodity? Why not the stock market? But why gold specifically? So here's the answer. Or at least before we get to the answer, this is what I want you to write down. Gold itself does not equal safety. And I need you to write this down. And this is super important. People think if I have gold, I'm safe. No, that is not true. And if you just notice that people who were hurting in the 80s and the 90s, gold actually hurt them more. Because gold fell from a high of 800 and bottomed at $243 2 decades later. So gold does not equal safety. Now, most people say, well, you want to have some gold, and there's a reason why you want to have gold, and they say it's durable, meaning it will last for a long time. It's very consistent. So there's like one type of gold. There's about 55 different types of oil around the planet. It's true. There's just gold. They say, well, it's divisible. It's easy to divide. This is why you want to have some gold. And you want to have some gold because it's a really good exchange mechanism. And you want to have some gold because it's nobody else's liability. There's no counterparty risk to it. But these aren't the reasons. And they'll say, well, you can buy it in US dollars and euro and yen and yuan and any other fiat currency. But that's not the reason. You want to own gold for one very specific reason. It's because it's going higher. The ltech gold strategy has this two-part system where it identifies the major cycle of the investment world. And then once it identifies that, I'm going to talk about this in a minute. And then it says, okay, it's identified gold. But now, should you be in gold for that entire 18-year period? And if you lived through 2013, 2014, and 2015 owning gold, you know the answer to that. And you say, no, you don't always want to own it. But why gold now? It's because it is going higher, because uncertainty is increasing. Now, this is 115 years of gold. Now, look at this. Gold goes up. Then gold falls, and then it goes up again. This is a cycle. This is a repeating cycle that is happening in gold. This is why I don't want people to own gold forever. If you own gold between 33 and 65, you lost purchasing power. If you own gold here, you lost purchasing power. That's 82 to the year 2000. So this is not about have 5 or 10% of money in gold forever. That's not the way you want to do it. You want a strategy that tells you when to be in and when to be out. And notice there's not 500 green arrows and red arrows. This isn't in today, out tomorrow, in today, out tomorrow. This is not a trading strategy. This is based on probability. This is not market timing. This is based on probability. And so we're in this up green. We're actually kind of where the red one ended and the green one's starting, and we're moving up again. And, you know, things repeat. Life repeats. And so we will have a down cycle after this. Even if the government fixed the price of gold at $9,000, we will have inflation then, just like we did between 1933 and 1965. So I keep talking about this cycle. So what is this cycle? So there's a strategy that I have called ltech gold. And it tells you whether you should own stocks or gold. And there's this very interesting relationship between stocks and gold. And I want to show you what it is. Now, there's 4 columns on this screen. So before your brain goes, oh my gosh, what is going on? Just stick with me, look at the cursor. First column is just calendar years, 1914, 1930, just the first column. Second column is what gold did during these years and what stocks did during these years and just how many years that was. So if we take this first one, from 1914 to 1930, gold fell 14%. During the same time period, stocks went up 159%. That was a 16-year period. So just notice this. There's certain periods of time where you want to be in stocks, and there's certain periods of time where you want to be in gold. Now, I use silver here because it was illegal to own gold. And there's periods of time where you want to go back to stocks and go back to precious metals and go back to stocks and go back to precious metals. Do you see that? This is a repeating cycle that's been going on a century. This is not just This did not start with Clinton or Bush. This was not any presidency, or this is not about Republicans or Democrats or who's running Congress or the upper or the lower house. This is about how humans behave. Underneath this entire strategy and all strategies, you have mass human psychology, what hundreds of millions of people are doing with their money. Now look at this. This is the same information, but I'm just showing it to you in a price chart. And this is a price chart of the Dow Jones. So look at this. There's periods of time where it goes up, periods of time where it goes down, up, and down. I got a little bit ahead of myself. And during these red arrows, that's where you want to own gold, or gold and silver, precious metals, because the market's not going to do anything, or it's going to go sideways. And even if it does do something, and I'm going to get to this in a minute, it's going to greatly underperform precious metals. So let's just take this section back in the 60s, the last time we were in a fully run cycle of uncertainty, and just look what the stock market did. 18 years of what I'm calling financial PTSD, post-traumatic stress disorder, financially speaking. The Dow Jones could not break above 1,000 for 18 years. Now, guys, there was inflation going on in the 60s and the 70s, and the stock market did nothing. Now, during the exact same time period, you had gold, which went from $35 an ounce, peaked out at $850, and then settled at $600. Now, I believe we're here today, but it's not enough to just know where we are. You have to know how to own. And just like we had 3 bad years in a row, the worst 3 years ever in gold, you have to know when to be out. And that's why gold investment newsletters is not the answer, because they're going to be giving you the pick of the week or the pick of the month or the pick of the day during 2013, during 2014, during 2015. What you're going to want to know most is the probability of whether you should be in the market or not. And that's what ltech gold does. Now, that was back here. I want to just show you what gold has done with stocks, because we're in one of those modes where gold outruns stocks. So look at this. ltech gold is the blue line, and the S&P 500 is the red line during this most recent cycle that we're about 16 years in. Now, ltech gold's up about 450%. And the reason it's up a little bit better than what you actually see in this price chart is because ltech gold told people who follow this strategy, to get out of the market right here. And during this whole time period, all gold investment newsletters they continued to just buy different ticker symbols or get out of this and get out of that. It's not about the ticker symbol, it's about the probability. And so even if the S&P did go up, which it is going up during this time period, you can see that yes, it's gone up, but man, it has been dwarfed by what gold has done during this exact same time period. And this is what the ltech gold strategy teaches people. So now there's some different scenarios that we could go into. If gold did what the NASDAQ did in the 90s, between 1990 and 2000, NASDAQ went up 13x. And if gold bottomed at let's call it $250, went up that 13x, you're looking at $3,250 gold. Now, if gold did what the Dow Jones did between 1982 and 2000, you could see $4,500 gold. If gold did now what it did in the 70s, it could go to $6,000. Now, I'm not telling you to believe this or not believe this. My point of showing this to you is there was no one in 1990 that's saying, yep, NASDAQ's going up 13x. Yep, the Dow Jones is going up 18x. Yep, gold's going up 24x. No one said that. In fact, that article from the New York Times said almost just the opposite. Here's the takeaway of this one specific slide. We have no idea how high gold can go. No idea. But what people want most is to know when to be in and when to be out, and they do not want to trade. If you're a trader, this is not the strategy for you. But what I find mostly is why people are trading. 2 reasons. 1, they think they have to because they read some newsletter saying trading is the way to go. Okay? Or 2, they're retired and it's kind of fun. But they just dabble in it. Right? If they have a $500,000 account, maybe they set aside $25,000 and it's something that's fun for them. Now here's the thing. A lot of people who have worked with me over the last 18 years, they actually live in Silicon Valley. And you may or may not know this, but a lot of people in Silicon Valley are actually very skeptical people. Now, I know Missouri's called the show me state, but Silicon Valley's like, yeah, prove it to me. And I want to share just something one of my clients from a long time ago Richard Green talked about, because he really touches on a lot of what's going on with people right now, and where they are, and kind of the concern they have for their future. And he makes just a couple really good points. And I wanted to make sure that I shared them with you.
I just now remember this. The night before the workshop started, way back then I did them on Saturdays. I spread them out over three
That's right.
between each
I remember.
You called me at like 8 o'clock at night basically saying, I'm not going to do it. You're like, RC, I don't think I should do this. The timing's not right. It was something like that. And I basically said, Richard, just show up. And if you don't like the first day, you will have lost one day of your life. I don't think that will happen. But I might even said, just show up for the morning. And if we get to lunch and you think it's a complete mistake, I will hand you your money back. Do you remember that?
You know what? Now you mention it, it vaguely rings a bell. But I did that. I can remember not wanting to
do it.
Spend the time. Well, just because it was another thing. So I was jaded. So just to give you a little background on Richard Green, I've been involved in the tech industry for about 25 years. And I've been on the executive management team of 8 startups, of which we sold 6. So, I live in a great house. I earn a great income. I have a fabulous family. I have great goals for my life, as well as affirmations for life, wife, family, and my community. I'm blessed with great fitness and health. And I struggle with the most with figuring out how to become independently wealthy. And my experience had always been with sort of big-name brokerage houses who would happily put me in stocks and shares and bonds and asset allocate. When the market went down, my money went down. And they'd say to me, well, it didn't go down as much as everybody else. And I just kind of didn't understand that. So I realized their motivation was to take a percentage of me, but it wasn't aligned with my success. So when I met RC, I realized I was generating a great income, but I didn't have the skills or the emotional maturity to manage wealth. So what RC did for me, which is just what he can do for everybody else, and it's just been a life changer, is figure out what I had been doing with money, which was losing it. Take control of the budget, which we didn't have, got aligned with my family, which we weren't, and put us on a strategy which would take the emotion out of the process and just allowed us to execute. It was less stress, it was less worry, it was less time spent looking at the day-to-day. So my recommendation is, if you are as serious about being as successful with wealth management as you are in the rest of your life, you need to spend some time with RC.
I just now remember this.
Now, I wanted to show, now you don't know Richard, and I know a lot of people have negative feelings about testimonials, but I wanted to point something out here of what he said. I don't know if you caught that at the beginning, but he said he was jaded. And I find out when a lot of people meet me, they've gone through what I call this cycle of investor awareness. They went to the big box advisor. Then they tried the independent and boutique advisor. And they found out that didn't work, right? Their money went up and down with the market minus fees, commissions, and expenses. And so they jumped over to the do-it-yourself world of workshops and newsletters. And unfortunately, then they were hanging out with their lesser self all the time. Their lesser self is that part of your brain that only shows up after something happens. It doesn't actually help you in the moment. And so people are jaded. They're hurt. Maybe they're skeptical. And yet they still want to figure out what really works. And that's why I wanted to show you and just share with you that conversation I had with Richard. And the thing that just stood out to me, he said to me, look, he didn't want to be alone. He didn't want to have to do this on his own again. He just wanted to simply plug into something that really worked for him, that had his money aligned with him and not some business model. And the way he did it was, I just said this, he aligned his money to the market, not a business model. He invested in a strategy and not a stock, or a stock each week or a stock each month, and just kept it straightforward. So why gold stocks, and why gold stocks don't matter as much as this? Now, this may sound weird to you that I'm actually telling you that gold stocks don't actually matter as much as something else, but you'll get very clearly why it doesn't matter in a moment, or why gold stocks don't matter, and why, in fact, I don't subscribe or believe in the idea that it's a new gold stock each day or each week, or let me give you all 10 gold stocks right now, but why it's not actually about different ticker symbols. So write this down. This is a principle. Every time you see this screen that says write this down, that's a principle. That's something that will never change. So here's the thing. It's probability, not diversification. People often believe that if they're just diversified, that they'll be taken care of. But actually, that's wrong. And if they just were to notice that every time they were diversified during every major fall, whether it was being diversified in real estate between 2006 and 2012, or being diversified in gold stocks between 2012 and 2015, or being diversified in any sort of stocks in 2008 and 2009, or 2000, 2001, and 2002, they'll start to notice that diversification is not doing the thing it's supposed to do, which is protect them. So it's not about diversification, it's about probability. And look, this is the conventional way of diversification. We'll get some gold producers and some gold developers and some gold exploration stocks, and we'll get some, metal, some silver, some mid-tier producers. We'll get the metal gold too, and maybe we'll throw some royalty stocks in there. And let's get some currencies like maybe the Canadian dollar, the Australian dollar, and maybe some small cap miners. Right? This is the conventional approach. This is how you do it. But actually, that's completely wrong. Because what if your conventional approach hits an iceberg? Yeah, everything goes with it. Now look at this right here. This is a price chart of gold from 2000 to the beginning of 2016. And you see a red bar here, and you see a red circle. And I want to talk to you about why probability and not diversification. So this red circle represents when ltech gold, the strategy, got people out of the gold market. And this red period defines the entire period that people were out based on ltech gold. Now I'm going to take this red circle and bring it over to the next chart here and just show you this is the same one. It's actually not, it's representing the same time where ltech gold said get out of gold. Now the blue line is definitely doing better than everything else, and the blue line does not represent my strategies, but it represents gold, and gold fell 44%. Better than silver, which fell 68%. Better than large cap mining stocks, which fell 80%, and better than small cap mining stocks, which fell almost 90%. The point is diversification didn't work, and it's never going to work during these huge corrections or collapses or sell-offs or whatever you want to call them. And this is why diversification costs people so much of their future, so much of their life, and why I just beat the drum and I rail against this idea of diversification and rebalancing. And this is why a pick of the month newsletter for gold is not going to help. What's going to help most is knowing whether you should actually be in the entire gold market or not. And as you can see here, when ltech gold got out, you eliminated this huge pain. Now, this was the worst 3-year period of gold ever. I showed this price chart at the beginning. This is what ltech gold said, get out of gold. And this is what gold did. And this is what ltech gold did. I can put the numbers in here. ltech gold went up 1.85%. I get it. 2% over 3 years is nothing, but it's better than losing 23%. And it's even better than having these heroic drops and rises in your life. That might be great if you're like 22 years old. But if you're in your 50s or your 60s or your 70s, no thank you. And one of the things that people love about ltech gold is it eliminates the noise. It eliminates a significant amount of the volatility, in this case in gold. You want to know the probability of when to be in and not what to be in. Now, of course, I show my clients what stocks to own, how to own, what metals to own, what coins to own, but that's not the difference that makes the difference. The difference that makes the difference is when to be in and when to be out. And that's why people love the ltech gold approach. And ltech gold did go into green light mode in 2016, and while gold went up 3%, ltech gold went up 13%. It's a way of leveraging and managing and aligning your money to the market, not your beliefs. I told you before, I'm not a gold bug. I'm a probability bug. What's the probability of protecting and growing your money? That's what you want to know first. And that was something that Alan and Liz really kind of clung on to. And they'd been searching for someone like me for 20 years. And Alan thought he should be trading, and he was trading. He had all these newsletters trading the market. He's like, now I just observe the markets. My returns have increased. Personal returns have increased 100%. And the reason why stock markets no longer concern him is because he has this approach based on probability. It's based on probability. And so, yes, the market falls. He doesn't time it and get out at the top and get in at the bottom, but he misses the majority of the fall. Write this down. Align your money to the market, not your beliefs. Right? Gold bugs were hurt in 2013, 2014, and 2015. I'm not making light of it. I'm not making fun of it. I'm simply pointing out that when people align their money to their beliefs, they get hurt much more than if you just align your money to what's actually going on in the market. And when I built the ltech strategy, that's what I want to know most. Tell me what the probability of making money is in the gold market, both that kind of that high level cycle and then kind of that green light mode within it. Align your money to the market and not your beliefs. And it's my belief that what most people are searching for is security and freedom. They want to know that they're never going to run out of money. They want to know that they don't have to move in with their kids, right? They actually want to be able to support their kids and their grandkids. They don't ever want to run out of money. And the way you do that with growing money in the stock market is you know the probability of knowing the probability, not a specific ticker symbol. And I get how this must really go up against conventional wisdom of people who buy into newsletters. Because newsletters rail against the industry. They're saying, no, don't do the big box advisor stuff. Buy different ticker symbols from me. But the problem is the human brain cannot handle all of those decisions. I mean, consciously, the human brain can handle 7 things at once, plus or minus 2. Well, if you own 20 ticker symbols or 50 ticker symbols and they all start going against you, your brain shuts down and you pay a huge biological and financial price on having way too much information. It's not about more information. I said at the beginning of this training, it's about knowing what to do. It's about knowing how to, actually, it's about knowing how to eliminate the noise. But there are a few people who have figured out how to align their money to the market and how to look at probability. And they don't have to do these really risky behaviors anymore. And risky behavior is owning lots and lots and lots of individual ticker symbols. That's very risky. And they're saying, maybe I don't want to be a trader. Maybe I don't need to have gobs of information on all these screens. I mean, it looks cool. I sound really cool at the cocktail party, but what's best for my money? And people are paying a financial and biological price by having so many ticker symbols and so much information and so many newsletters. And it's hurting them so much that one day their brain just kind of shuts down. Right? I mean, people are good at maybe a few months at this, maybe even a year, maybe even 2 years. But then something happens and they give up all of what they gained. Or they forget about it, or they move on to something else. This is not how the human brain is designed. The idea of investing was invented in 1980. Yes, the top 1% over the last 1,000 years has always been investing in some way, though you could probably argue investing really came about 100 years ago, but that was only for the top 1%. Before that, the kings and queens just really killed people. There was no investing, there was just stealing. But, it wasn't until the invention of the 401k in 1980 that people really had to think about, how do I grow my money? This is very new for the human brain. It's only 46 years old. And the human animal has been around 2 million years in evolution. And this idea of having to grow money to protect your future is super brand new. Because before you had a pension, you worked your whole life for a company, you had a pension, you got the pension, then you died. So what ltech Gold gives my clients is they know they won't run out of money. They know they'll have enough. They know they'll have control over their future. People don't want to be a burden on others. People don't want to be a burden on their spouse or their kids. And so they're looking for that thing. They're skeptical, not cynical. They're skeptical and they still know there must be a better way, what really works. And you need to ask yourself, is your advisor or newsletter making your future safer? Is it making it more secure? And most people would say no. And that's why I built the ltech Gold strategy. And ltech, again, stands for long-term economic cycles with gold. Like, how do we know whether you should have money in the gold sector earmarked for it or stocks? That's what ltech Gold describes. And I talked about that before. It's like a baton between two runners running around a track. You want to know which runner has the baton. And the runner that has the baton, that's where you want your attention, right? Like between 1982 and 2000, the stock runner had the baton, and that's where you wanted your money, regardless of your age. But then in the year 2000, the stock runner handed the baton to the gold runner. And gold has been beating stocks, not every day or every week or every month or every quarter, or even every year, but over these long runs around the track. And in this case, the track, in the picture is 400 meters around. But in the real world, these cycles last about 18 years on average, some longer, some shorter. And it's that knowing what cycle we're in and then knowing what mode within the cycle we're in, that's the difference that makes the difference for people. And that's why I wanted to show you the actual data. You're not going to get this from the big box advisors or the independent boutique advisors. It's too risky to show you. First of all, they never believe it. And it might sound weird to some of you, but most people in the industry, they actually don't know much about investing. They've never done the research. I was fortunate enough that in my mid-20s, I earned a very good living when I got out of college. I lived in Asia. I was at Southeast Asians major in college. I earned very well, and I was able to spend the rest of my 20s really figuring out what really works. And this is what really works. But here's the thing, it takes time. It takes years to dig through and look at the evidence, not your bias, not your belief, not your sacred cows, but what is actually happening, not what you want to happen. And when I talk about the big box advisors or the boutique advisors or the independent advisors or Wall Street or the newsletter industry, the workshop industry, what I'm saying is they're all in. I'm not saying they're good. I'm not saying they're bad, but they're all in. Barron's is even on it. I just saw an ad, and I've seen this ad. I just see it. It comes out every year. It says the number one independent advisor in America, the number one advisor in America by Barron's. You know what that's based on? It's based on revenue. It's based on sales. You have to think for yourself, and that's what this conversation with you is about. And that's what this information is about. Now look at this in 2013, 2014, and 2015. The buy and hold gold crowd, whether it was a newsletter or something else, it was a really bad 3-year period for buy and hold gold. That's why I call it B&H gold. And it was down almost 37% just those 3 years. But the ltech gold was down a little over 4%. Now it matters for a couple reasons. One, you lose or you keep a third more of your money. But even more importantly, you keep your sanity, you keep your will, you keep your determination, you keep your focus to continue the course and focus on what works most. This is about doing what's best for your money. And you've seen this price chart before where gold goes up, then it goes down, then it goes up, and I said I'll get to this later, and it goes down. Well, if you get a gold newsletter, which is fine, they're never going to tell you, please cancel your subscription with me. Gold has plateaued just like it did in 1933, and we're just not going to do anything. You will keep trading and churning and buying and reading, which is okay, except it won't be best for your money. Now, I'm not saying you won't make money in gold in 1980 and in the 80s and the 90s. You probably wouldn't. But more importantly, it's not whether you can squeak out a return. More importantly is what should you be in? What should you be in, not what can you get away with? Remember, if you want to write something down, write this down. Do the minimum that gets you the effect you want, not as much as you can do. And we humans have been designed to do as much as we can do. And since we don't have to plow the fields and look for water and kill the animals, we have a lot of time on our hands. And so we think we have to do everything. And that is hurting people's lives, their security, their future, their freedom. So kind of a pop quiz here. What's more important, the ticker symbol or the asset class? Now, the best investors in the world say asset class is the most important thing to understand, meaning, do you know what asset class is performing best in the investment world? Because look, if you buy and you have a pick of the month newsletter that is selling you pick of the month stock tips, or, ticker symbols from the stock asset class. But what's the best sector asset class to be in is actually bonds. Well, that time period that you're in stocks is going to have a lot of headwind. And so what's most important is knowing which asset class is doing well over the entire cycle. And that's one of the things that ltech does, long-term economic cycles does. It tells you, hey, look, we've entered into an 18-year cycle where historically, over the last 120 years, the best asset to own is a physical asset. Now, I get, of course, more granular. I get very granular because in physical assets, you have real estate. Then you could break that down even more. You could have commercial real estate and residential real estate, right? You could have fourplexes, what type of real estate, and then you could go over to the commodity side. Is it energies? Is it softs? Is it metals? So it's not just about the asset, but what specific asset class does best, right? Because people often believe, and they've been taught this by the newsletter industry, which rails against Wall Street and the industrial investment complex, and yet they are actually part of that industrial investment complex. And what they say is you've got to know the ticker symbol. And the answer, that's actually not true. And if you just notice, if you buy the right ticker symbol in the wrong asset class, it may do better than the other ticker symbols in that asset class. But wouldn't you rather know that, hey, actually over the next 18 years, based on history, probability, weight of evidence, that in fact bonds are going to be the best asset class to be in, despite your age? It's not about being 60 or 70 and owning bonds. It's about that is the best asset class. And the same thing goes if you learn that the best asset class over the next 18 years, like it's in the 80s and the 90s, that's going to be the best place to protect and grow your money. That's what ltech is doing. It is telling you and giving you this information saying we are in a cycle in the investment world that says that physical assets are the place to be. That's what ltech is going to do. That's what people are really looking for. And that's what they're saying to me. That's what I've been hearing for years, saying, RC, I don't think it's about ticker symbols. I've got 5 newsletters. I'm overwhelmed. I'm hitting decision fatigue. I love the stories. They're super exciting. It gets my hope going. I love knowing more than other people do about a specific stock or company or sector. But my portfolio is not getting bigger. I'm exhausted. What people really want is to know, just tell me what the big picture is. Tell me when to be in. Tell me when to be out. Not timing. I don't want to be a timer. But, based on probability. It could even be currencies for a little bit. Though currencies are almost always a place to just kind of put your money for shorter periods of time because the historic trend on currencies is down. Currencies have a long-term track record of losing value about 2 to 4% a year, depending on what currency you're talking about. But all currencies fall in value over time. Okay, so I've been talking about ltech gold, which is my strategy, long-term economic cycle for gold, knowing when to be in gold, knowing when to be out of gold. And so what I've done many years ago, I said, I want to make this information accessible to people. And it's not black magic. I actually want to put a checklist together. Literally like, this is the procedure. Step 1, do this. Step 2, do this. Step 3, do this. A checklist so you can literally pick it up. It's a piece of paper. And you can look at it and go, I know what to do. That brings power into your life because now you're consciously competent and you understand what to do next. You're no longer relying on a monthly subscription that is going to feed you another ticker symbol. You've become consciously competent. What I also wanted to do was actually give you the research on why it works. What's the upside? What's the downside? When does it work? When does it not work? What will it look like when it does working? What will it look like when it looks like or appears like it's not working? And so put all the support research together. And of course, I know that sometimes people just want, just tell me what to buy, RC. Right? Do I buy metal? Do I buy mining? Do I buy large cap, small cap? Do I buy silver? Do I buy gold? Which one do I buy and when? Should I go leveraged? I know there's leverage positions. When should I be leveraged? Should I be out? And so I have a video for you that literally tells you, just tell me what to buy. I'll tell you what to do. Because remember, it's not so much about what you own. It's about how you own it. I also give live monthly support via Q&A office hours. So you're never alone in this. You can ask me questions about the strategies. You can ask me questions about what's going on in the market. You can personally ask me questions, and that is every month. One of the things I've heard for years from people who buy and consume and leverage and use my research is connecting with you is probably one of the best things that I get. And then you get the complete training videos. Now, this strategy, this ltech Gold strategy, this is what I'm offering to you, that you can have it, the complete training videos. I literally go video by video, step by step, and I show you exactly how to put this strategy together. And once you watch it, and I'm not talking 300 hours of videos, we're talking 15, 20-minute videos, a half a dozen of them that show you exactly what to do in what order. So you're like, yes, I know what to do. I have the clarity. And I know today, if you go and buy a newsletter on gold exploration companies, those are up to $5,000 a year. And they just focus on gold exploration companies. But guess what? They were recommending gold exploration companies in 2013, 14, and 15 when gold fell 45%. It's not what you buy, it's how you own and when you own. That's the difference that makes a difference. And I know there's other newsletter services that are maybe only $3,000 a year. And one of the things I vowed to do when I started allowing people is offering my research to people is saying, look, I want to make this as accessible as possible to the most people that I can. I want to be fair to me, and I want to be more than fair to them, which means offering up my research for probably less than I should. And that means maybe someone paying a little bit more than maybe they want to, but they get what it is. And so if you added up the numbers on the screen, that gets you $6,000 to get this entire strategy. But I'm going to offer it for $997. And if you pay annually, that's the number, is $997. You get the complete structure, formula, videos. I tell you exactly what to do. I'm along with you for the ride. I will run as fast as you for $997 a year. I tell you what precious metals to buy. I tell you what mining shares to buy. I tell you when to put on your leverage positions. I tell you what coins to buy if you want to buy coins, and so much more. This is not all of it. I'm just giving you a little bit of it. And I tell you when to sell. I tell you when to step aside. I can tell you firsthand and secondhand that if you own something that has fallen, even if you've stepped aside and watched it fall for 3 years, one of the biggest concerns that person has is, okay, if I get back in, what if it falls again? And having that mechanism to signal you, to alert you, to say, hey, things have changed, step aside. To have that agnostic kind of indicator. So ltech also tells you when to sell. You get the monthly calls, which include what's working now. I tell you what's working now. Yeah, I give you a 30-day forecast, not just on gold, but on the entire market. What is going on? A lot of people who consume and use my research, they have other investment vehicles. They have other investments. In the 30-day forecast, I literally look forward into the future based on the price charts. And I say, this is what the price charts are telling us. Not the news, not our beliefs, but the price charts. It's a very powerful monthly kind of research piece. And you get that every month. I also offer you something that I call speed investing. This is where you give me your ticker symbol right there on the monthly call and say, RC, please go look at Facebook. And I, right there live, I deconstruct Facebook on a daily and a weekly and a monthly chart. I tell you what I like, what I don't like. I tell you if I had to buy, where I would buy, where I'd place my stop loss. You can bring your information to the monthly call. It's not about just what, the research that I provide you. It's a back and forth conversation. And of course, the live Q&A. And then I give you a review on the actual strategy itself. How is it doing? What's working? What's not working? Never be alone. One of the most dangerous things humans do when they invest, especially when they invest for themselves, when they're kind of doing the do-it-yourself plan, is they get too much into their head. They don't reflect enough with other people. What's best for someone's money is to get into a dialogue with someone, to think out loud with someone. Never be alone. Never be alone. And so to make this access right now for 24 hours only, $997, is to make it at a level that can be more accessible to more people. So I'm going to actually give you immediate access to what to buy now, instant access to the entire ltech strategy, support with the training videos, monthly conversations with me, and I'm going to give you a 90%, just try everything money back guarantee. So let me tell you what this 90% money back guarantee is. I give you everything. This is not a newsletter where I dole out one ticker symbol a month and you're kind of waiting on bated breath, or your Pavlov's dog, starting to slobber because you hear the next pick of the month ticker symbols coming up. I give you everything immediately. And I know many services where they give all the information up front, they have a no money back guarantee. But I get it. So a 90% money back guarantee in the first 30 days. I'll let you know when to be in, when to be out, what to own, and what to avoid. And there's very little activity while still being while still being able to greatly accelerate your money. It's not about doing as much as you can do. It's about finding the minimum dose that gets you the maximum return. Medicine has figured this out with their medicine. Only take this for 10 days. It's the minimum dose with the maximum benefit. But somehow in the industrial investment complex, they're giving you all these things to do, and we humans think, well, we have all this, so we must do all this. That's hurting people. And look, if you don't like the service, we'll return 90% of your money in the first 30 days. And for that $997 for that annual payment, you get full access. And the details matter. The nuances matter. This is the difference. This is one of the differences that makes a difference for people. It's not enough to just know, oh yeah, gold's going to go up. Yeah, but what if it stops going up for 2 years in there? Then what? What if mining shares are actually the best place to be over metal? What if silver's better over gold? What if actually gold's better now than silver? And having that information, those are the details, those are the nuances. It's one piece of data. Right on the screen here, there's just one thing different between that monster on the left and that amazing entertainer on the right. Just one teeny thing, a hat. That's it. Details matter. Details matter that got people out of gold at the end of 2008 and then got them right back in. Details matter. Nuances matter that kept people out of gold in 2013, 2014, and 2015. It's not what you own, but when you own it and how you own it. And look, people were, newsletters were given, gold investment newsletters were telling them to buy certain ticker symbols this whole path down. It's not about ticker symbols. It's about probability. Back here between 2000 and 2011, gold went up 423%. That's awesome. But during the exact same time period, ltech gold went up 845% on the blue line. People say to me repeatedly, get my life on the blue line, get my investments on the blue line, get my security on the blue line. The ltech gold best gold stock ever? It's the blue line. We give you different ways to invest so it fits your personality. The red line is the gold bug index, which has been around since 1980. The details matter. This is a price chart of the worst 3 years ever for gold. This is ever, not just in the last 10 years, but ever. Now, gold was actually down much more, but, from here down to the trough, and then it came up, when we got the signal to get back in, gold fell 23%. But you don't want your life on this red line. Look at that. That's traumatic. ltech gold over the exact same time period was up, a little under 2%. And many people would say, man, I'd rather have 2% than negative 23. But it's not even that. That's like of course they would. But it's avoiding these heroic falls and rises and falls and rises. People don't want that. Maybe that was fun in your 30s, but people don't want that in their 50s, in their 60s, in their 70s. They want to make sure that everything is taken care, buttoned up, and they won't get hurt again. And this is what happened to ltech gold when we went into green light mode for gold. ltech gold went up 13%. Gold fell 3%. Gold went up 3% with a 10% difference. But here's the thing. if you buy in the next 24 hours, I want to give you a super amazing bonus. And there's actually two parts to this bonus. And this is the first part. I want to give you access to all of my research. All of my research, not just ltech gold, but ltech bond, market probability 1, which I call MPX1 and MPX2. And I want to give you access to deep value real estate and my entire investment library. Everything I've produced. And the way I produce my research is that it's evergreen, right? So the deep value real estate course, I made that in 2004. It's 12 or 13 years old. And I have people just literally just last week, someone pulled it up. They emailed me like, oh, this is not updated. And then they pulled the tools and they plugged the tools in. One tool specifically called the house analyzer. Like, oh my gosh, this tells me exactly where to buy and what to say and how I know. Because here's the thing, principles never go out of date. All my research is designed to be evergreen or timeless. It's not based on what's happening right now. It's based on, principles that don't change. So you get access to all of my strategies that I've ever created. As long as you're in good standings and a paid up subscriber, you get all my new research going forward. So if I create a new strategy, for example, how to buy cars, because the used car market is where there's something to do. I put it in there and I let you know. I do not upsell you on it. And then, of course, you get the monthly support. What do you buy now? Office hours, 30-day forecast, speed investing, and probably most important, alerts. Tell me what is going on, alerts. And you get that if you buy in the next 24 hours. This is ltech bond, in case you want to know. That's the blue line. That's the strategy ltech bond being compared to the S&P 500 from 2000 to 2016. Not bad. This is market probability 1, MPX1. This is during the 2008 crash. Now, it's hard to see what MPX1 is, but there's actually this blue line that's flatlined that you would have made 0.4%, while during the same time period, the 2008 crash it bottomed here. That was a 58% bottom here, okay? But by the time you get back in, literally your cash had increased in value 25%, and you would not have gone through this horrific 58% fall. That's what market probability 1 is, and you get that. This is what happened to MPX1 in the 2000 crash. MPX1 went up a little over 11%, while the S&P in total fall, the S&P fell 49%. But by the time MPX1 got you back into the market, your money in buying the stock market bought you 43% more stocks. That's the value of a strategy. And then we have MPX2. And MPX2, as you can see here, is up 231% during the most recent bull market, while the S&P during the exact same time period is up 107. I want you to have access to this. Now, you don't need to go read it. Just because it's there, it doesn't mean you have to go consume it. I'm simply letting you know, if you order in the next 24 hours, I will give you all of this research. I will give you all of this research. You'll get access to all this research. Now, here's the thing that I'm most excited about. I hate when I buy a service and then it's just relentless upsells. You think you got the service you're supposed to have, and then you find out, oh, but no, there's this. It kind of sickens me. And so I am saying to you, I promise you'll never be upsold on any of my research. If I come out with something new, you will get it. I mentioned this before, but I want to be clear. This is no upsells at this membership level. You'll get access to all new research, updates, changes while you're a paid up member. And the only thing people pay more for is my personal time, my mentoring and my coaching and my money management. Those aren't upsells. I mean, it's not research upsells. It's like, hey, just so you know, I also offer this other service. It's a completely different thing, an entity. It is my personal time. And those who are able to get my personal time have said, and I've been at this business since 1998, it was probably the best time spent. And so I know that personal one-on-one time, specifically talking about your money, is something that comes back to that person many times over. No upsells from my research ever. So when you do buy, you'll see a contact form. You'll see an order form that looks like this, and you put your contact information in, you'll put your address in, you'll put your credit card information in, and you'll pick your type of service, which is actually below this. I almost said below the fold, but it's below here, you can't see it. And when you do that, you're going to go to, where you're going to go then after that is you're going to go to a page that looks like this. And this is where it says, hey, do you want a second opinion? Would you like me to review your portfolio? Would you like me to actually implement these strategies for you in your accounts? And so this is an offer to get on the phone with me to see if we might be a fit and see how I might be able to help you. And the main focus of this is to find and identify that biggest gap in your investments and fill it. And then once you say yes to this, you'll actually get another order form, which I don't have an image of it on here. But after that order form, you'd go to a questionnaire page. And this questionnaire page is really important because I want to make sure I get the logistics out of the way before we get on the phone with each other. I want our one-on-one conversation to be solely focused on what's working, what's not working for you, and I want to be able to identify what that biggest gap is. Is it something with your behavior, something with a belief, to help you with that? And if I can help you right there, I absolutely will. And if it's a bigger, if it's a problem that resolves, kind of needs a bigger solution, we'll talk about that. But it's a conversation where you and I are focused solely on your money. And I will keep this offer up for the next 24 hours where you get access to all of my research, where you will never be upsold on any new research at this membership level. And again, as long as you stay in good standings and you're paid up subscriber, you will get all future new research. You'll get full access to my investment library, and you'll never be upsold. So there's a lot of questions that have come in, and I want to cover some of those questions for you. Now, you may notice that your specific question doesn't get answered, and that's because as I've been going through this, people have been asking questions, and a lot of times what I do my best to kind of batch the questions together. So I'm not asking a 1% difference between questions. So the first one that came in was, should I buy gold or gold stocks? And that came from Jerry J. Good name. I'm going to tell you exactly what to do when you get access to ltech, the ltech strategy. And yes, there are times where buying the metal is better than buying the stocks. And there's times where actually buying the metal is better than the stock. And so I will answer that for you. And it would just be unfair for me to answer that question to you right now to my paid up members. Next question is from Mark A. Does it work in IRAs? Absolutely. This strategy works in IRAs. That's an easy one. This one comes from Larry L. Does it work in 401ks, 403bs, 457s? So the ltech gold one does not for the majority of those. Probably about 98% of those, it will not work in it because those investment structures are very, very restrictive. But what does work in those accounts, including RRSPs and superannuations and annuities, is the MPX strategy, the MPX1 strategy. In fact, I designed and created that to work within a 401k or a 403b or a 457. So it does actually work within there. Okay, next question. Let's see, Ricky C. Are you talking about gold stocks or gold options or metal or coins? What are you talking about with ltech? So there's just a little clarity that needs that Ricky, it is Ricky, that Ricky would like. This is about whether you should or should not even be in gold. Whether you want to buy coins, I will show you how to do it. Or bullion, I will show you how to do it. Or silver over gold or gold over silver, or having your money in a vault outside the country you live in, I will show you how to do it. Or buying mining shares, I will show you how to do it. Or buying exchange traded funds, I will show you how to do it. But the foundation of protecting and growing your money is not in the ticker symbol, but it's in the probability of whether you should be in the entire asset itself or not. That's the difference that makes a difference. Thanks, Ricky, for bringing that up. Okay, let's see here. This is Jim H. Hey, RC, I'm retired and my money is geared towards income. How can this help me? It's a great question. A lot of my clients that identify with my strategies and my approaches and kind of my evidence-based thinking, they are, between 55 and 65 years old. Though I have lots of clients that are 45 and even some that are younger. And so this is not about, it's for old people or it's just for young people. It's for working people. It's for retired people. This is about identifying how to align your money to the market more so than your situation. So Jim, your situation is, you didn't say your age, but I'm guessing you're probably over 65, that you have a portfolio. You didn't say what your portfolio size was, but let's say it's $100,000. And let's say that portfolio makes you 5%. So you get $5,000 a year of income. Okay, well, let's say you took 10% of that portfolio, or $10,000. Now that would lower your 5% interest to 4.5. So there's gonna be a cost there. You're gonna lose 0.5% of income a year, or $500. So your cost is $500. Okay. But you take this $10,000, and I'm not saying you did know me, but let's say you did know me back in 2000 or 2001, and you put that $10,000 in ltech gold. Well, I know over the last 16 years, that $10,000 would end up being $55,000 today. Now, you would have more than made up for the cost of that loss of that $500 way before now. In fact, very early on, you would have made up. But the point is now there's an extra $45,000, which would never have been there, and you could get way more than your $500 back. Depending on your age, you could be pulling $1,000 a month extra, or $2,000 a month extra, or even $3,000 a month extra, right? Because you had that extra $45,000. So you could actually pull an extra $3,000 a year, almost, obviously not, almost doubling, you're getting 2/3 more, right? So in this case, you would get $7,500 of dividend-like income by even putting a small percentage of your money in this strategy. So I have seen it work very well for people, Jim, that have their portfolios geared towards income. Okay, this one's from Rich K. What if the metals pull back and starts breaking down? He goes on to reference some newsletter people who are saying gold's going to go to $700 and the Dow Jones is going to 3,000. One of the things that the members and subscribers love about this approach is it's agnostic. And if we go into what I call red light mode, you step aside. And we don't know how long we're going to be in red light mode. Now, the last one we were in was for 3 years. I didn't foresee that happening for 3 years. I was like, we'll be in, 6 months, maybe a year. We were out a year. When I ran this portfolio in the 70s, you had been out for 1 year, but we were out for 3 years. So if, gold goes to $400, you're not going to participate in that fall. All right, this question's from Steve T. What are the signals? Let's see. Hold on. Let me read this. You use your moving average. Yes. What moving averages do you use? Do you use moving averages to help you with your signals? Yeah. So one of the alerts that I use is a combination of two moving averages, a fast one and a slow one. So an example would be a 50-day and a 200-day moving average. Those are not the ones I use. They're very commonly used moving averages, but they're actually not the most accurate pairing because they have a lot of false signals in them. But yeah, one of the triggers that we use, and it's a multi-step trigger to make sure that we get the least amount of whipsawing, is in fact using moving averages. And I tested many pairings to find the most accurate ones. Okay, this one's from Janet J. I got the names today with the rhyming first and back. So Janet, you had a question about membership. So yes, membership is $997 if you do the annual renewal. And I see what you're asking, like you wanted to be clear. And Thanks for your question. Yes, you are hearing what I said. You'll get complete access to the ltech strategy, which I show you how it works. I make you consciously competent so you know exactly how it works, and I show you how to implement it, which includes the ticker symbols and the ETFs and when to be in, when to be out. But I show you exactly how to implement this strategy into your life. Okay. And yes, I also provide you access to all my other research and strategies. And I will give you access to all my to be determined future research that I put together, which means I will not upsell you any more research. I will not upsell you any research at this membership level that you're at. No upselling. And then, yeah, so Janet, yeah, so correct. And then the only thing I really offer other than my research is my personal time through mentoring or coaching, or sometimes people say, RC, I get how this strategy works. I am not implementing it. Could you please implement it for me? And because I'm a registered investment advisor and a certified financial planner, people come to me and ask, could you just please do this for me? So that is actually correct, Janet. Thank you. Thank you for bringing up that. Hey guys, I will keep this offer live for the next 24 hours. Then I will take it down. You can go to peakgold.org or there might be a button right there for you to just to connect on. So thank you so much for being in my world. Thank you for being part of this training. I really appreciate your time. Time is the most precious commodity on the planet, or at least it's the most precious non-renewable commodity on this planet. And thank you for listening to this and being in my world and asking the questions. And I did my best to kind of batch all the questions together. So if I missed one of yours, I apologize. And if you are interested in getting this and you don't want to use the internet to buy from us, that's totally fine. You can just email Patty, and that's patty@fearlesswealth.com, Patty, Patty. Or you can just give her a call, which that number is 650-257-0207. And just so you know, I'm always doing trainings, but Patty's kind of working hours are Monday through Friday, 9 a.m. to 5 p.m., and that is Pacific time. Thank you guys so much. I'll speak to you soon.